Hi, this is Kathleen Uckert. I'm a senior analyst here at Value Line. My colleague, Alan House, joins me today. Today we are going to provide an update on the economy and stock market. We will then discuss our Value Line Select Dividend Income and Growth product, and finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those just joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The investment survey includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, 5 easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly in print and digital forms, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no stake in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer, or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. Value Line's economic staff prepared this content. The Federal Reserve lowered the benchmark short-term interest rate by a quarter point at its September monetary policy meeting. It marked the first action from the Federal Open Market Committee, FOMC, since last December. The central bank also left the door open for additional reductions before year's end. While policymakers are still watching the pace of inflation, a bigger concern right now for the lead bank is declining job growth. The labor market is weakening. This was reflected in several key data points, including minimal job gains this summer. The unemployment rate ticked higher to 4.3% in August, while the labor force participation rate remains low. This suggests increasing slack in the labor market. It also should be noted that a recent report from the Bureau of Labor Statistics showed that U.S. employers added far fewer jobs than originally thought in 2024 and 2025. For the 12-month period ended March 31st, payroll totals were revised lower by 911,000 jobs. The U.S. economy is slowing. The Congressional Budget Office, CBO, is estimating that gross domestic product, GDP, will advance 1.4% this year, which would be half the 2024 rate. The CBO cited reduced immigration and its impact on the supply of labor, along with tariffs as the primary reasons for its lower GDP forecast. That said, it remains to be seen if the CBO is underestimating the possible positive impact of the new budget bill, which includes tax cuts and regulation rollbacks on GDP. Third quarter earnings season will be closely watched. It will provide a clearer picture as to whether businesses or consumers are bearing the increased costs due to tariffs. The August retail sales gain of 0.6% was double the expectation, indicating consumers are spending. However, the September Consumer Sentiment Index fell 21% year over year, with survey respondents showing concern about a weakening labor market and higher prices due to tariff policies. The state of the consumer sector will likely play a huge role in how aggressively the central bank cuts interest rates. Conclusion. With the Fed resuming interest rate cuts, equities may get a boost if the inflation data cooperates. Still, with valuations extended, a portfolio of high-quality stocks and cash-equivalent securities is recommended. Now I'll walk you through the selection process for the latest stock to join the Value Line Select Dividend Income and Growth Featured Portfolio. For this, we will turn our attention to the Value Line Stock Screener. I will now show you how to access it. Once signed in, head to the dashboard where I am already located. This is the main landing page for subscribers where you will find economic commentary, supplementary reports, and other up-to-date content. From there, we want to choose Browse Research and navigate to the screener. One thing I want to touch on is that the screener is just one element of our selection process and helps us sift through the thousands of equities in our database using targeted, relevant criteria. Anyone can select any number of different screening criteria and come up with a list of stocks. However, what separates Value Line Dividend Income and Growth is that Value Line follows a process, starting with specific complementary criteria to meet our goals under the supervision of deeply experienced Value Line analysts. So step 1, safety rank of 3 or higher. We want to focus on companies that are as safe as the average equity under our review. Hence, we will focus on companies that are ranked 3 or better for safety. Keep in mind that our safety system ranks stocks from 1 to 5 based on their relative risk profile. After screening for this ranking level, we have whittled our list down to 2,123 stocks. That number includes stocks we follow on an automated basis, along with those that are assigned to one of our analysts. Step 2, timeliness rank of 2 or better. We want to focus on stocks that are ranked to outperform the broader market averages in the year ahead. After screening for this factor, we are now down to 368 stocks. Step 3, dividend yield of at least 3%. We want to also look at the dividend yield. While we are looking for stocks that have solid dividend growth potential, we also want to focus on equities that have a yield that is above the Value Line median. After conducting this screen, we are down to 40 companies. Step 4, dividend growth 5-year of 15% or better. Lastly, we want to focus on companies that have above average dividend growth potential over the 5 years ahead. Specifically, we are looking for at least 15% growth in the distribution over that time frame. After running this screen, we are down to 5 stocks. Those 5 stocks are Best Buy Company, Cal-Maine Foods, Hess Midstream, Nextar Media Group, and Upbound Group. You will likely be familiar with the names of some of these well-established businesses. After a spirited discussion among our senior analysts, we decided that Nextar Media Group would be the newest featured selection for the Value Line Dividend Income and Growth portfolio. About the screener, Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or more fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. Please note that screens can be saved and revisited by utilizing the Create Saved Screen button at the top of the page. Now let us click on Nextar, where we will find the landing page for the stock and Value Line's digital report. We can also click on PDF reports near the top right of the page to find the most recent full-page reports on Nextar. So that's the most recent report of Nextar Media. And now we can look at the latest Value Line Dividend Income and Growth report, which was reported very recently. And now you see the Dividend Income and Growth report, which highlights that Nextar Media Group owns America's largest local broadcast television group, comprising over 200 stations affiliated with major networks like ABC, CBS, NBC, and Fox, along with the national network, the CW. As you can see here on page 8, we look for the company to post solid top and bottom line gains next year on the heels of a sharp earnings decrease in 2025. We look for a marked earnings recovery next year, fueled by the 2026 midterm elections. Given that local broadcasting is critical for political campaigns, Nextar's expansive network of stations will likely attract significant advertising revenue. The company also has a strong presence in battleground states, which also augurs well for profit growth. Nextar's earnings have proven to be heavily influenced by the 2-year political ad cycle, with marked top-line surges during midterm and presidential election years. The company is also looking to remain active on the acquisition front. For instance, in August, it announced intentions to combine with Tegna Inc. in a deal valued at about $6.2 billion. The transaction, which is anticipated to close in the second half of next year, subject to the usual regulatory and shareholder approvals, would combine their station portfolios to create the nation's largest local television and media company, reaching nearly 80% of U.S. households. These shares are worthy of consideration for investors seeking above-average dividend income growth potential. We expect solid annual earnings gains on average over the 3 to 5 years ahead, fueled by internal growth and acquisitions. The company has a broad reach in the advertising market, and we look for further traction in the years ahead. Conservative accounts ought to note that earnings on a year-to-year basis are uneven at times due to their correlation with election cycles. However, recent strategies, including the revamping of the CW network, ought to help smooth earnings comparisons over the long run. Generally speaking, we try to hold positions in the dividend income and growth portfolio for at least 6 months before considering a sale. Of course, this depends on broader economic conditions and the health of the overall stock market. Generally, we try to diversify the portfolio across a variety of sectors in order to help boost the overall return. While it may be tempting to focus on stocks in a high-growth segment, as the old adage goes, it's not a good idea to keep all of your eggs in one basket. It should also be noted that while we screen for dividend income and growth selections, we also discuss qualitative factors that may add value. The screens are good for quantitative metrics, but sometimes there are qualitative or intangible variables that are difficult to incorporate into a screen. Product brand awareness, management talent, and susceptibility to sharp economic downturns are just a few examples of factors that may be difficult to screen for. We hope this gives you a good overview as to how we screen for the dividend income and growth stocks and what is included in our monthly report. We will now tackle a few questions. Please note that we typically cannot answer complex questions about specific stocks on the spot.
Thank you, Kathleen. This is Alan. The first question that came in was, what factors should you consider for dividend-paying stocks? That's an excellent question. There's several factors that should be considered for dividend-paying stocks. First off is the dividend yield. The dividend yield is the annual dividend payment as a percentage of the stock's current price. It is a key metric for evaluating how much income you receive relative to your investment. Another factor is the dividend payout ratio. The payout ratio is a percentage of a company's earnings paid out as dividends. It helps assess whether the company can maintain its dividend payments. Another factor that bears watching is the dividend growth history. Dividend growth history refers to the company's track record of increasing its dividend over time. A consistent history of raising dividends signals a company's financial strength and management's commitment to returning value to shareholders. The company's overall financial health is also a factor. That's a company's ability to maintain and grow dividends is tied to its overall financial strength. Strong cash flow and manageable debt levels are essential for a company to continue paying dividends, especially during tough economic times. The business stability and the sector that it's in is also a factor. Some sectors are more reliable for dividends because they have stable and predictable business models. Some sectors that come to mind are utility, healthcare, consumer staples, telecom, and they're often more resilient in downturns, while sectors like energy or cyclical businesses might be a bit more volatile. Still, another factor is management's commitment to dividends. A company's management's philosophy towards dividends is important. Some management teams are more committed to returning profits to shareholders through dividends, while others might prioritize reinvestments or potential acquisitions. The valuation is also a factor. A company's stock price in relation to its earnings, assets, and dividends can tell if the stock is overvalued, undervalued, or fairly valued. The dividend coverage ratio is also a variable that bears watching. This ratio measures how well a company's earnings can cover its dividend payments. A higher dividend coverage ratio means the company is less likely to cut its dividend. And finally, there's economic and market conditions, such as interest rates and inflation. Regarding interest rates, dividend-paying stocks can be sensitive to changes in interest rates. In a rising interest rate environment, fixed income investments like bonds may become more attractive, making higher yielding dividend stocks less appealing. Inflation is also a factor. Inflation can erode the purchasing power of dividend income, so look for companies that have a track record of increasing dividends faster than the rate of inflation. Another question that just came in, I've heard of this company in the Jimmy Kimmel controversy. Do you feel that local station owners such as Nextar are likely to run into regulatory headwinds? Television stations are some of the most visible institutions or businesses in their local communities, and it's natural that they're going to be involved in some controversy. However, despite some occasional loose talk, we regard it as unlikely that any station owner will actually lose its valuable asset, its broadcast license, over any particular political or regulatory matter. I'd also mention that short of losing a license, sometimes regulation of advertising can be a blip in the business model. For instance, long ago, cigarette advertising was one of the biggest categories of business on television. Then one day that ended. Recently, there's been a broad rush of proposal for discussion by the administration in Washington of returning to the times when ads for prescription drugs were mostly prohibited. We question whether that will happen, and in any event, despite the catchy jingles, prescription ads are not in the top half dozen categories of television advertising. Another question is, how are dividend-paying stocks good in volatile markets? Another very good question. Dividend-paying stocks can be a smart play in volatile markets for a few reasons. Number one, they provide a steady income stream. Even if stock prices swing wildly, dividend-paying stocks will still provide regular income. That's like getting paid to weather the storm. This income can cushion the blow during market downturns. There's also implied financial strength. Companies that consistently pay and even increase dividends usually have strong cash flows and solid balance sheets. That stability can be reassuring when other parts of the market are shaky. Also, lower volatility. Dividend-paying stocks, especially from big, well-established companies, tend to be less volatile than non-dividend growth stocks. Investors often flock to them for safety, which helps stabilize the stock price. There's also the total return advantage. In volatile markets, capital gains might be hard to come by. Dividends contribute to total return, which can make a big difference if share prices are flat or declining. Finally, there's also reinvestment opportunities. If you're reinvesting dividends, you're essentially buying more shares during downturns when prices are lower, which can supercharge your returns when the market recovers. Thank you. Kathleen?
Yes. So there's a question here, somewhat similar. What are some key indications or indicators that signify a reliable dividend stock? Well, there are several indicators that can help, and free cash flow coverage jumps out as one. Healthy and consistent free cash flow that comfortably exceeds dividend obligations indicates the company can fund payouts even in weaker earnings years. So that's something to look for. The dividend track record is another. A long history of paying and ideally growing dividends through different economic cycles shows commitment to shareholder returns and resilience of the business model. Another is the balance sheet strength, which I think Alan touched on. Low to moderate leverage, ample liquidity, and conservative debt management reduce the risk that financial strain will force dividend cuts, and definitely don't want a dividend cut. Earning stability, companies with predictable recurring revenue streams like utilities, consumer staples, healthcare are better positioned to sustain dividends. So earning stability is another indicator there. And the dividend growth rate. Steady measured increases over time are preferable to unsustainability or unsustainable high yields, as growth demonstrates both confidence and capacity. And then there's industry positioning. Firms with durable competitive advantages, pricing power, or regulated revenue models often provide more dependable payouts. And then there's the payout ratio. A moderate payout ratio, like Alan had referred to earlier too, often below 60% of earnings, suggests dividends are well covered by profits and less likely to be cut. There's another question too, kind of touches on what I just talked about here, the payout ratio. Why is the dividend payout ratio an important indicator of sustainability? And there are several reasons, I guess you could list. First off, it measures the financial health. So the payout ratio, dividends, which is dividends divided by net earnings, shows whether a company can comfortably cover its dividends. So again, as we talked about earlier, a ratio between or below 60% typically suggests sustainability, as it leaves room for reinvestment, debt repayment, or weathering economic downturns, while a high ratio, above 80%, for example, may signal potential strain. So you want something that's low. Also, it's important because the payout ratio indicates dividend safety. So a lower payout ratio implies a cushion against earnings declines. And it also reflects growth potential. So companies with moderate payout ratios retain more earnings for reinvestment in operations, innovation, or acquisitions, which supports long-term dividend growth. Also, it signals risk of overextension. So a payout ratio exceeding 100% means a company is paying out more than it earns, often relying on debt or reserves, which is unsustainable long-term. And you want to stay away from that. And then also it guides investor expectations. So a stable or declining payout ratio over time suggests a company can maintain or grow dividends, which appeals to income-focused investors. And then conversely, a rising payout ratio may warn of future dividend reductions, especially in cyclical industries. So those are some of the reasons why, it's good to pay attention to the dividend payout ratio, in addition to, the other indicators of a reliable dividend stock. Alan, is there any others from your side?
Thank you, Kathleen. That's all the questions we have today. I'm going to send it back to our producer, Peter. Thank you.
Thank you, Alan, and thank you, Kathleen. Thank you to our remote attendees for joining today's session. This does conclude today's event. You may now disconnect your lines and have a great day.